Welcome to another episode. My name's Jose Najarro, and today we're going to take a look at Macy's earnings, Q3 for fiscal year of 2020. Like always, I have my buddies Bull Solo and Darth Bear ready to keep track to see how the company's doing. So let's get started. All the information collected either comes from Macy's Investors website, the Seeking Alpha, and I've also used MarketWatch to get some data. So if you guys want to go, feel free to take a look at any of those websites. I get all my information from there. The first thing we're going to take a look at is Macy's stock returns. So in the past 5 days, Macy's has returned 3%. In the past month, 2.3%. In the past 3 months, 5.8%. Year to date is down 48%. That is some crazy value. And in the past year, it's down over 55%. So we can see this company has taken a beating, and hopefully we can see in today's episode why it has taken that beating, and has that beating, is it time for it to flip around? All right, so the first thing we're going to take a look at is revenue. So for Q3, Macy's reported a non-GAAP earnings per share of 7 cents. This was a beat by 8 cents. It also reported GAAP earnings per share of 1 cent, and it missed by 3 cents. Revenue was $5.17 billion, and it missed by $140 million, which is not too big, but it's still bad to see a miss. So because we did see a miss in GAAP earnings per share and a miss in revenue, I'm going to have to give the first point to Darth Bear, not to Bull Solo, to Darth Bear. So the first point goes to Darth Bear. So we're going to see where this company lost its sales. So overall, like I mentioned, net sales are down. So net sales same time last quarter in 2018 was $5.4 billion. Compared to today's, this quarter was $5.17 billion. So there was a decrease of about, I think 2.something%. I don't have the actual value here, but it was in the nice low single values, a percentage drop. Credit card revenue was also down. So credit card revenue same time last year was $185 million. This year was $183 million. Macy's does tell us that the main reasons for the drop are the following. For the sales drop is this quarter, cold weather came in slower than anticipated. So with cold weather coming in slower, less people were buying the winter clothes and all the cold weather clothes. But because summer was already over, people had slowed down in buying summer clothes as well. So it was between the period where people were not buying much because the weather, it was too soon for cold weather, but it was already too cold for warm weather. The other thing they say is there is a slowdown in tourism, and that's showing slower sales in the store. And finally, they had some downtime with their application and I think their website when they were trying to fix some issues, and this caused them to do some sales. The reason there was some downtime in their e-commerce world, in the applications and the website, was because they are preparing for the future for these holiday sales. So that's one good thing that came out of it. Net income, if we take a look, net income is pretty much zero. That is this bottom value. Net income right now for this quarter was $2 million, where same time last year was $62 million. And some of the things we can see here is gains on sales of real estate. Last year was $42 million. This year was $17 million. So they had less gains this quarter. The cost of sales and general administrative were more expensive, right? They were more valued. They were a higher percentage of sales. So cost of sales this time were 60% of total revenue, when last year was 59.7%. And the cost of selling general and administrative expensive this quarter was 42.6% of sales, where last year was 41.7%. They also had higher restructuring costs, where this year it was $13 million, where compared to last year was $3 million. So we can see all those things start to add up, and we can see why they had a lower net income compared to same time last year. They also do mention that they do mention some of their categories across their business, and there is strong performances in mattresses. So I guess a lot of people are buying better mattresses, fine jewelry, fragrances, dresses, men's active, and men's tailored. The weaker business in the quarter included women and men's sportswear, which makes sense, right? This goes hand in hand with the cold weather situation. Less people are buying cold weather, right? Cold weather activewear, but at the same time, they're not buying summer activewear because it's already too cold for that, but not cold enough for the winter wear. And they say here, especially the cold weather items, handbag, housewares, and furnitures were also down. So here in comparable sales, right, we see net sales are down, credit card revenues are down, net income is down, and those are not good things to see. So another point to Darth Bear actually here. All right, we're gonna spend some more time here in comparable sales and just talk about where some more metrics, right? So Macy's actually just started this new item, Vendor Direct, and Vendor Direct can be seen like more like a eBay within Macy's store. So it allows other vendors to come and sell items using the Macy's website. So this, even though the actual sale is not a Macy's product, because they're using Macy's website, so I'm pretty sure you guys have seen it in Walmart and Amazon and all these, you have extra sellers outside of like the main sellers. And a portion of that sale revenue goes to Macy's for allowing these vendors to use Macy's website. So Vendor Direct is fueling online growth throughout increased selections with addition of nearly 1,000 vendors and 1 million items year to date. And they are pleased to have relaunched same-day delivery to complement the same-day in-store pickup option. So that's another good thing. I don't normally shop at Macy's, but I do when I go to the mall. I do pass through Macy's, right? It is the entrance to the mall, which I think is pretty good. And I have seen that their stores have gotten better. They look a lot brighter. They look a lot brighter, and they also have. It seems like they're doing a lot of same-day store pickup where they have the locker rooms, and I think that's pretty good. That's showing the progress within the store. One thing I did not know is Bloomingdale's is actually part of Macy's, and Bloomingdale's saw its strongest sales performance in stores year to date and experienced growth in both its digital business and outlet stores. They've also launched this product called My List, and it's performing well. And what My List is, it's a subscription-based product. So we all know, right, Bloomingdale's is a little bit more high-class items. So they're doing a subscription-based, I think it's $200 and something a month. And people pay this subscription-based, and they pretty much, it's like how Netflix used to be with DVDs, but with clothes. So people would rent out clothes, and it's usually high market clothes, right? Is your high value products, and they rent them out, and then once they're done using this item, these clothing outfit, they send them out back, and then they receive the new one. There's more into it, but that's pretty much how it is. And the easiest way is DVDs. It's the Netflix DVD versions of very expensive clothing and outfits. So while it's still small, they are seeing promising results, and I actually think that's pretty cool to try something new. This is something I have not seen other people try, and I definitely want to see where this is going. Bluemercury had another strong quarter with double-digit sales growth and opened 4 stores in the quarter. So even though I did give a point to Darth Bear here because comparable sales are down, there is some small things that we can see here that are doing good, right? Bloomingdale's saw its strongest sales growth. Bluemercury is actually opening up stores. If stores are being opened up, that is great, right? Right now, we are in a world where retail stores and retail companies are being hesitant to open new stores because they know it's just going to build up more expenses. So for them to open up 4 more stores of Bluemercury, it shows that this part of the business is doing good. With regards to company sales transaction metrics, overall transactions fell 4% compared to the same time last year. And 4% is not that big, especially when there is a trend going down with transactions. So 0.4% is definitely not a big deal. All right, so now some things to note. These are going to be things that I'm going to mention that don't have an actual point to Bull Solo or Darth Bear, but I think they are worth mentioning. So first, within the sales, general, and administrative expenses, they recorded $2.2 billion expense in the quarter, with $53 million less than last year. And they say that this dollar reduction reflects both that they're doing cost containment and lower variable costs associated with sales. So that's pretty good, right? Even though 53 million is a very low percentage, very, very, very low percentage of that $2.2 billion. It's still good to know that they are disciplining themselves. Year to date, cash flow from operating activities was 172 million compared to 429 million last year. And that is pretty scary, right? That's a huge drop. Same time last year was 429 million, and right now it's sitting at 172 million year to date. But they're saying they give this explanation that this is due primarily to the timing with accounts payable. So normally I'm gonna assume that accounts payable usually hits in the fourth quarter. It hit in the fourth quarter last year, and that's why this company had 429 million in quarter three and only has 172. So this year it hit in quarter three. They do mention that this is not indicative of the strength of their full year expectations. So they are expecting to see similar results, maybe a small percentage decrease compared to the same time last year. Some other things to note is they will continue to expect to use excess cash to further reduce their debt in the fiscal year of 2019. And they're doing this through volunteer debt repayment. In the past trailing 4 years, they paid over $3 billion of long-term debt. And that's always a good thing, right? We always want to see a company being able to pay off debt and not keep accumulating. So we're going to take a look at its balance sheet in a bit and hit this subject a little more. And just capital allocation plan. This is pretty good, right? We want to know what this company's plan is in capital allocation. And first, their number one priority is investing in their business. That's a good thing. The second thing is to continue to maintain a healthy balance sheet. That's a good thing. The third thing is to continue to pay an appropriate dividend, cash dividends to shareholders. That's also a good thing. And my favorite thing is that this is under first investing in business and then maintaining a healthy balance sheet. After they have those two things, then the next thing they worry about is dividends. And finally, the last thing they worry about is to resume their buyback program, which they don't have right now one, and they haven't had one in some time. But that shows that they are going with priority, right? They're first making sure they're investing in their business, and we're seeing that happening. Next, they're continuing to maintain a healthy balance sheet, which we're going to take a look, and they're going to continue to pay an appropriate dividend before even buying back shares. A few more things to note is after the 7 consecutive quarters, that's pretty good. I did not know that this company had 7 consecutive quarters of comparable sales growth. Macy's experienced a deceleration in third quarter sales. They did anticipate this negative comparable sales, but the sales deceleration was steeper than they expected. Macy's will host an Investors Day at 8 o'clock Eastern Time on Wednesday, February 5th, 2020. And management team will share details of the Macy's Inc. growth strategy and 3-year plan. So now we're going to take a look at future plans. So future plans, I'm automatically going to give a point to Bull Solo, and the reason is I do believe a company needs to have some form of roadmap of where it's going to go. Obviously, I can't tell the future, so I don't know if the future plans themselves are going to work, but it is good enough to have a plan and to be moving forward. So Macy said it will spend the most money in 2019 on these 5 areas with the goal of growing sales and improving profits. The first thing is Growth 150 plan. So the Growth 150 plan is a pretty simple concept, and is Macy's has strong stores. There are some strong stores, and these strong stores, they want to outfit them and by adding new lightings, new fixtures, and new merchandise. They want to make these 150 stores stand out so they can keep bringing products. The second is Macy's has this thing called Macy's Backstage, which is the retailer's off-price business. So Macy's it's not the most expensive place to shop, but it is more expensive than some of the competitors. So it has Macy's Backstage, which usually has heavily discount apparel and home goods, and they're trying to open up more of this Macy's Backstage. And I've seen that, like I mentioned, in that Macy's I walked by now has Macy's Backstage, and I can see that they are actually doing this. Third, Macy's says that it will work more closely with top vendors this year with the goal of getting hot items to the market more quickly. Fourth, the company will say it will think mobile first and continue to update its application. And this is something we saw, right? One of the reasons that they had a slowdown in quarter 3 was because they were focusing to having their application and website ready for the upcoming season, holiday season. And lastly, it will invest in categories where it believes it can gain the most market shares: dresses, fine jewelry, women's footwear, and beauty. It could stand to take some of the market shares as rivals as Sears and JCPenney's falter. So that's a good thing and a bad thing, right? It's a good thing because, right, Sears and JCPenney's are coming out of the business. So all those customers that used to go there now will most likely go to Macy's. But it is a bad thing, right? Because if those stores fail, then what's stopping Macy's from falling? So it's a double-edged sword when you take a look at it. But right, I do like these plans. My favorite ones are definitely the Growth 150 plan, where they make the stores that are doing stronger, make them even stronger. Then they're focusing on discount apparels, right? So that's always a great thing to have more items inside the stores and allow more customers in. And I do like the third one where they're focusing, well, the fourth one, but it's my third favorite, where they're focusing on mobile applications. So now a quick update on the future plans. The first is within the Growth 150 stores. They did finish updating the all 150 stores. And one of the stores is actually the stores that I mentioned that I walk by in the mall all the time. Like I said, they have updated the lightings, the fixtures, and all the merchandise. They even added backstage. And I always do see that Macy's pretty full, so I understand why they updated that one. And they do say that the growth stores continue to outperform the rest of the store fleet. So that's definitely good, right? Focusing on the strong, keep building strong on where you're good at. And that's what they're doing. The next is they did achieve their full year goal of expanding backstage to another 50 stores. They exceeded backstage expectations in the quarter, and backstage locations open for more than a year continue to perform well up mid-single digits and have improved both margins and turn rates. All right, next we're going to take a look at shareholder return. This company has no repurchase program, but it does pay a dividend. It has paid $349 million year to date, and it's paying the same per share amount as they've been paying of, I think it's 37 cents. Yes, 37 cents. They do not have any near-term plans to change this dividend. And again, that's a good thing. Right now, this company is able to pay dividends. So while it's going to continue to, but the moment it's unable to, this company knows that it's going to have to stop to continue with its business, and that's okay with it. So for me, that's going to give another point to Bull Solo because they are paying dividends. Next, we're going to take a look at the company's balance sheet, and this is first we're going to take a look at the assets, then we're going to take a look at the company's debt. So first, cash and cash equivalents has dropped from $736 million to $301 million compared to the same time last year. Merchandise inventory are at similar levels of last year as they are right now because they are preparing for holidays, right? November of last year, they had $7.1 billion of merchandise. This year, they have $7.25 billion of merchandise. And we can see, right, that's pretty good that they have similar levels because it means that they know what they have to sell. One thing is last year, they had some excessive inventory left over, so this is something that I'm gonna have to take a look at in the next quarter to see is this excess merchandise still happening. Total current assets are $300 million less than they were a year ago, and that's right. Last year was $8.6 billion. Right now they have current assets of $8.3 billion. To me, that's not that scary, especially if when we take a look at debt, we're gonna see that they have paid off some debt. So it's okay for me to see total current assets drop. One thing to note is if we take a look at total assets, right? Total assets last year, same time, was $20.3 billion. This year was $22.5 billion. So just taking a look at this, people will be like, oh, wow, that is a great thing. This company is increasing its assets. But one thing to note is last year, they did not have this extra right of use assets, which I think is leases. It's retail lease assets, and we can see right last year they did not have this, and now they are, and it's adding a $2.6 billion to the total assets. If we take that off, this company has about $20 billion flat of total assets, which is almost to similar levels of last year. Last year they had $20.3 billion. Right now, if we take off that 2,596, this company would have about 20 billion flat. So there is not much difference, about 300 or 400 million different, which I think it's okay and it's nothing to worry about. So now we're going to take a look at the debt. So we're going to take a look at the same thing. The first thing to note is short-term debt. Last year, this company had 65 million of short-term debt. Now it's sitting at $6 million of short-term debt. So that's pretty good to see a decrease in that. Another good thing is we see similar results in merchandise accounts payable. Last year was $3.38 billion. This year was $3.42 billion. So not a much. There's similar levels. Same with accounts payable. Back then was near almost $3 billion. Right now it's sitting at $3.05 billion. So these values are the same. And that, to me, again, that regenerates that this company knows what they're doing. They're not increasing their liabilities dramatically. So I am liking that. Next, we're going to take a look at long-term debt. So long-term debt has dropped about $800 million. Last year was $5.5 billion. Right now it's about $4.7 billion. So this is a great thing to see. I keep saying it's a great thing to see, but it is, right? If for a sector of retail space that there are companies that are falling down, right? We see Sears fall down, JCPenney's falling down. It's good to see a retail company, being able to pay off its long-term debt. It gives hope to investors that this is not going to be one of those titans that falls. Total debt, though, if we take a look at total debt, they don't actually add it up for us, but we can do the math. Just like I mentioned in the assets that there was something that was being added this quarter compared to and not added a year ago, there is the same thing. So long-term lease liabilities was not a thing last year, and it is a thing now. So this is just because there are new accounting practices going on where the SEC requires that they do this now. So that's why they did not have a number for it last year. So I'm going to now add up the total debt of the company without using long-term lease, so we can be comparing apples to apples. And total debt, not counting long-term lease, right now is sitting at $13.7 billion. $13.7 billion. A year ago, it was sitting at $14.7 billion. So this company has decreased its debt by about $1 billion since a year ago. And that, like I mentioned, is very good to see. And that makes me pretty hopeful for the company. So obviously, I'm going to give a point to Bull Solo because we did not see a huge decrease in total assets, right? We saw pretty much flatline in total assets, but we do see a huge decrease in total debt, which is, like I said, a point to Bull Solo on that one. So I think right now it's a 2-2, but that's unfortunately going to change pretty quick. Wait, actually, it's a 3-2 right now, right? Bull Solo has 3. Darth Bear has 2. So now we're going to take a look at the outlook based on the company, and this is pretty much just guidance that this company gives us. So originally, this company was projected to have a flat to small growth year. Now they're actually projecting to have a minor decline. Net sales, they were supposed to be approximately flat in the prior guidance, and now they're expected a 2.5 to 2% down. So just to put that in perspective, right? 2018 revenue was $24.97 billion. If we estimate the worst case scenario of 2.5% down, this means that 2019's revenue will be $24.35 billion. Another thing, so that's definitely not a good thing to see a decrease in sales from a year ago. You want to see increase in sales happening, and you want to see an increase in earnings per share. There is another thing, is that in the revision, if we take a look at the revision, here they have earnings per share. So back then they used to have $2.85 to $3.05 of earnings per share estimated. Now they have $2.57 to $2.77. So about a decrease of, what's that, 30 cents in earnings per share, a little less, more like 28, right? 28 cents in earnings per share. But there's something different going on here. Assets on sales gain. So back then they expected that they were only going to sell about $100 million in assets, which was a total of 25 cents per share. Now they're expecting to sell $150 million, or 37 cents per share. So that's 12 cents more per share, right? 12 cents more per share. So if we actually take off that 12 cents more and assume that they were selling that 100 million only, and this would give us a true apple to apples comparisons, right? Because this is the most important thing that you want to do when comparing items. You want to make sure you're comparing it with what you were comparing it last time. So if they were comparing with 25 cents per share, and now they're comparing with 37 cents per share of asset sales gain, let's bring that 37 down back to 25, and what would we go? And now that 257 would actually be $2.45 to $2.65 compared to the original $2.85 to $3.05. So that is a huge decrease, and that's actually that's not a sight I like to see. And I can see why this company has dropped down has dropped over 50% in the past year. And while I was looking at the 10Q report, I was also taking a look at the 10Q report of the previous quarter. And in the previous quarter, they actually lowered their guidance again. So I think originally, their original guidance was somewhere between $3.05 to $3.25. Then they dropped it to $2.85 and $3.95. And now they dropped it again to as high as $2.77. So that is not a scary thing. And that's something investors should take a look at and should be worried about. Next, we're going to take a look at Outlook based on analysts. So earnings per share growth is none, right? So earnings per share this quarter is to be $2.65. This is lower than same time last year. And look, for January 2021, it's expected to even decrease even more. So normally you see the forward PE ratio going down as the years increase, but here you're seeing the opposite. You're seeing as in the future, the forward PE ratio is actually getting higher. And this is not a scary thing. This is probably margins are getting lower. Next, we're going to take a revenue. So revenue is also expected to decline, but not by much compared to earnings per share percentage rates, right? For this year, revenue is expected to make $24.52 billion. And let's compare to what we calculated before. So we calculated about $24.35 billion. So we're around the ballpark of where analysts estimate. And for 2021, it actually is decreasing to $24.44 billion. So a decrease of about $100 million. And like I said, it's not a big difference. And we can see with the forward price to sales ratio, which is pretty low. I think that is actually pretty low. But it is increasing. So it means there is a decline in revenue growth. But the company, if the company can turn things around, this can actually be good for the company. But unfortunately, right now, I have to give a point to Darth Bear here. So I think Darth Bear took the lead here, and this is actually a pretty crazy company, right? I think I have 3 points on Bull Solo, and I have 4 points on Darth Bear. So now my thoughts, right? This is going to be my thoughts. First, I'm going to talk about the cons, right? And even though it does seem like cons definitely has less bullet points, these cons I feel are valued are more heavy than the pros. So the first con I have is there is a decline in both revenue and earnings per share for the next 3 years estimation, and that's not a great thing. You don't want to invest in a sinking company. The next is they did expect a decline in quarter sales, right? I did mention that Macy's expected a decline in sales, but the decline is bigger than they anticipated, and we can see this because they have done numerous changes in guidance to bring down the guidance. So I know they dropped down guidance this quarter. They dropped the guidance in quarter two. So that's it seems like the guidance just keeps going down, and that's because they're not anticipating this big drop. And that's a huge con, and it relates with that revenue and earnings per share. Another thing is, this is a very competitive area. We have seen some of the big guys falling, right? JCPenney and Sears are on their last leg, and they're falling. So what's stopping Macy's from getting the same fate? So now we're gonna talk about the pros. Some of these pros I like pretty good because they're factual facts. The others are some of my optimisms within the company. Unlike the cons, right? The cons are straight facts, right? These cons that I've mentioned are what it is, and this is what's actually happening. Pros, one of the good things and one of the heavy pros that I like is that they are still paying down debt and not increasing it, right? So that's definitely a great thing, right? To see this company not needing to take out more loans, to take out more debt, and actually paying at a huge rate, right? It paid off $1 billion in the last year alone. They're still able to pay dividends, so it means this company is still has money to return to shareholders. That one is not as strong, but I do like it. And the other 2 points that I'm going to mention, I want to say are more optimism, are me just being optimistic, right? So I like their future plans. So 3 of the 4, I do believe that the company needs 3 to 4 points, and that's it. That's all they need. They just need to focus on 3 or 4 points, because I know when they only have 3 or 4 points, that's where they're focusing, right? If I see a company has a whole list of things to fix, it makes things less impactful. But when they only have 3 or 4 things, then I know the company's serious about making these changes. The first is they're fixing stores, and not just random stores. They're fixing the stores that are providing the best growth. That's a good thing. They're going mobile. They're increasing their mobile range and making sure they have a great application and a great website. And they're adding Backstage stores, which increase the type of customers they're getting, right? Backstage has discounted apparel, so it's bringing a whole different selection of customers. So like I said, that's pretty optimistic. And if those things end up doing strong, this company can actually flip things around. Another good thing is, it's pretty funny. This is in the cons list, but it's also on the pros list. Some of their major competitors are gone. Like I said, JCPenney and Sears are gone, are coming out of the picture. So with them gone, Macy's is able to grab more potential. Those customers, those are potential customers, right? If they're able to grab those customers, then it will do a great thing for Macy's as a whole. For me, Macy's is actually a company that I would not invest fully in, right? It's definitely not a company I would invest fully in, but it's not a company in its dying breath just yet. This company still has life to it. And I think right now, Macy's, if these things work off, things will flip around for the company. And for that, I would be gladly to purchase some shares of Macy's. And on it, I've had all this information, but I haven't been able to produce the episode until now. But me looking at these information, I did decide to purchase some shares, and you would see it, and you're gonna see it in my account video that I did buy some small shares of Macy's. So let me know what you guys think about this episode. I hope you guys enjoyed it. This was actually it took some time, just right. Holidays coming in, I had some other things to do. But hopefully I can do some more episodes by the end of this weekend, maybe 2 more before Sunday. So I hope you guys enjoy it. But one more thing, right? If I do keep, like I said, I would do a small investment on Macy's. But if I keep seeing this decrease going down within the years after 2021, then that to me would be a moment where I would say, hey, I was wrong, and back out of that deal. So yeah, make sure to guys give me a thumbs up. Post any questions you guys have on YouTube comments. Take care and have a good night.